Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for May 18th of 2025. Well, we certainly have a lot of tariff news to talk about, and we could spend the entire slide deck on this. With the last, I really call it the last 6 weeks in the bag, it's just been an incredible and tumultuous journey from what we're talking about in some jurisdictions well over 100% tariffs, which basically cuts off trade at the knees, to the announcement of the UK deal and negotiated, I guess, near-term acquiescence with China, limiting those tariffs to basically just around 30%, leaving 10% elsewhere. Even still, these tariffs are more than the average tariff that we had before we went into all of this. And you can see here on this chart, and this is the journey that we go through, right? I mean, we've got the starting weighted average tariff entering the Trump administration around 2.5%. And then we add on top of that, China, steel, aluminum, and then we were talking about cars, and then semiconductors, and then pharmaceutical tariffs, and then these are the reciprocal tariffs that were kicking in, outside of China, and then the Chinese tariffs that really got everyone unnerved, and then we provided some exemptions, and then we had the China-U.S. mutual tariff reduction down from 145% to basically 30%. And so where we are now is really about 14%. So that, even though all of this news feels good in the sense that, wow, at least we dodged a bullet here, well, 14% is still a hell of a lot bigger than 2.5%. And we still have to contend with the impacts of this. And, just as an example, Walmart this past week said that they're starting to feel margin pressure on imported goods from China. Of course, the Trump administration said, you just need to eat it. But, that's not economic good sense from Walmart's perspective. And so there really are core pressures at work here that are going to need to be reconciled. And obviously the market feels really good about things right now. And I just worry that we may have a little turbulence in the months ahead. Here's a second chart that kind of shows you tariff effects. This chart is showing you that, this summer we're going to get tariff effects on the goods side really kicking in here, because this is, basically the last chart, even 14% over 2.5%. I mean, we have tariffs, we have prices that are moving up on imported goods. And until there's a substitution or some type of rationalization in demand or consumption, you're going to see this in the pipeline. And so you're going to see this increase in overall pressure on these prices as a result of tariffs, and we're going to see it here in just a couple of months. Very noisy chart here, but this really speaks to the heart of a lot of what I've been talking about over the last month or so, and that's the difference between soft data and hard data. And so what we have is this 3-month kind of moving average, if you will. And so basically this is soft versus hard data. And so you've got, these two categories independently and then kind of this composite. And so we've seen this thing really drop out of the floor here. And that just means that, the gap between the hard data, which is actually still not bad, and then the soft data, which is actually really bad, just from the sense of people are extraordinarily pessimistic. And their expectations for the next 2 to 3 months are really not that good, even though they seem to be turning because the stock market has turned. But again, the difference between the soft data, which has not been terribly good as of late, and the hard data is there's a big gap. And I think that those two reconcile over time. You can see that this is a very noisy chart, actually going back to 1972. And you don't see these kinds of deviations very often, but you certainly see it right now. Interestingly enough, on the tariff issue, I think one of the various underpinnings, depending on which day you're listening to a press conference from the White House, the underlying goal is to bring more jobs to the U.S., and in particular manufacturing jobs, because we're talking about the goods sector here. Well, I found this really interesting. So this is data out of the St. Louis Federal Reserve, and that we still have basically almost a 500,000 jobs in the manufacturing sector that are vacant that we can't even fill domestically. So if you're saying, all right, the goal is to bring another 3.5 million manufacturing jobs back to the U.S., well, we've got 500,000 here almost that we can't even fill right now. Now we get into some of the data from the past week. We've got producer price, the producer price index (PPI). This is the month over month. This was negative. On its face, you would feel, okay, great. Well, producer prices are going down. And then here's core PPI, and that was down. I mean, these numbers are kind of like almost shockingly well below estimates. And then you can see trade services on the PPI side. We haven't seen, a number this week since last year. But basically, this is because margins are shrinking. This is not the Walmart, because Walmart is, more in the retail side of it. But these are, you call it like auto manufacturers and other producers of materials where, intermediate goods are being imported over. Their margins are shrinking. So their prices are falling, and that's constricting their profitability already. Here's a quick look at core goods PPI, and so what this is telling you is that this is moving higher as it, for the most part, has been doing for the last several months. Now we have retail sales, and we've got both the ex-auto and gas, and we've got the control group, and those were definitely below expectations. So this is something that, this in particular, the control group was well below. The ex-auto and gas can be a little fickle, but that was a little bit weaker than expected. But down here, what you're really looking at is, this data over here, the retail sales chains. I mean, obviously, you've got retailers, which, we've already talked about in some respects, sporting goods, which is, when you talk about, categories in their aggregate, impact. I mean, obviously, you've got health, personal care, which is down slightly. These were down slightly. And then you had electronics and appliances, and then building materials, all moving up, but on balance, we've got retail sales in the control group moving down just a little bit. Now we take a quick look at the Atlanta Fed GDPNow estimate, and this is for the second quarter, and this is what we talk about a lot. It does a really good job of forecasting. It really did an excellent job in the first quarter, at least in the first reading. And where we see now the blue chip consensus, and this is the range of estimates, and you can see how wide that is now. But the consensus, that meaning the average, is about 1%. The Fed, as of the data it can see at the present time, is looking for something closer to 2.5%. And I think if that's the case, then that's probably going to be the best quarter of the year, I think. At least from what I can see right now. All right, so we've got some data, reasonably good on the hard data side. Some data not so good on the forecast surveys, the soft data stuff, and then you've got estimates for higher GDP. So naturally, I say this tongue in cheek. You've had market pricing for the number of Fed rate cuts move up a little bit here as of late. And so, I think we were talking as recently as a week ago about maybe just 2 cuts, and now that's moving up a little bit. But again, until you get up here, then you really can't start averaging up to 3. But right now, what would represent is essentially 2 quarter-point rate cuts. In other words, about a half percentage point of decrease in the Fed funds rate. But we still have the the potential for inflation in the pipeline. As I showed you earlier, the average tariff rate is estimated to be around 14% by Goldman Sachs judgment, and that's a lot higher than where we were. So, I mean, there is some inflationary impacts that I think could make it more difficult for the Fed to lower rates. But what we see elsewhere, central banks in other parts of the world have already lowered rates, and of course, this is creating quite the conundrum for the U.S. dollar. And here's basically a survey which is showing you that the estimate in May, the May reading here, is that we've got 46% looking for 2 rate cuts, and then a lesser percentage actually looking for 3, which I can't fathom at this moment that we would have 3. But again, there are people out there that feel like we should have more rate cuts. So this is a chart showing you the breadth of earnings. This is out of Refinitiv, and by this estimate, with this gauge falling as it is, the earnings revision ratio, this is basically a kind of a symptom of pessimism on the part of analysts that are in charge of kind of setting earnings estimates for publicly traded companies. And by this estimate, you would think that you should have easing by the Fed. And so that's delineated by these kind of pink shaded bars here. And that does typically correlate to periods where earnings estimates are being revised down, which is where we are now. So by this one measure, you should have earnings rate decreases, but by other measures of perhaps expected inflation, it kind of puts Fed in a little bit of a weird spot because they certainly don't want to crater an economy. They don't want an economy to go slip into recession because they're not easing in the face of some slowing growth. But they certainly don't want to accelerate inflation either. So right now, they're taking a little bit more of a wait and see approach. But I think a rate cut is psychologically important to the market right now. Market expects 2, but if they get 1, probably the estimate now is really kind of looking into maybe even the July to August meeting. And by the time we get to August, certainly by the time we get to the August timeframe, we will have had the first reading of second quarter GDP, which will usually come out at the end of the calendar month following the end of the calendar quarter. So that would be the end of July. And so we'll know a little bit more about the pace of economic growth then. And I think that's when the Fed's going to begin to make judgments. And again, their dual mandate is not only stable prices, but also full employment. And we do see that employment is still relatively strong. And so there is that. All right, some credit indicators. We've been watching this for a while. We've got credit card loans. You can see that those are moving higher. You've got auto loans, which are moving higher. And again, if you go back, this is back to 2008, back in the global financial crisis and how this bubbled up. You can see we're not too far on credit cards and kind of almost at the same level on auto loans. And then you've got student loans, which, as we well know, were held in abeyance. And so these things dropped off the table, but now they've come back up. But again, when we go back to pre-pandemic levels, we still have a ways to go there. So, all right, the health of the consumer. We talk a lot about how, like, going into the pandemic, consumers were lowering their debt loads, and you can see, that was definitely in full view here. And then, they began to, increase their debt loads, and now they're in kind of I'll call them a net deleveraging mode. And these are all the income cohorts, and you can see every single one of them is moving lower. Well, that's a good sign. if you feel like you may have some economic turbulence by virtue of tariffs, et cetera, this is a good sign because your consumers are still on a relative basis pretty, more, I'd say, healthier, even though, as we just saw, we've got credit card and auto loan delinquencies that are picking up. On this side, we see consumer debt growth over a 3-year period, focusing in on this light blue. Here you can see, home equity, lines of credit, and credit cards, mortgage, student loan, etc. You can see in all of these categories, with the exception of student loan, that we've had debt growth decline on a sequential basis. And again, this is the only outlier. So, and you can see total, you can see that that's transpired over a period of a couple of years. And so, again, another sign that perhaps the consumers in better shape this time around than they were the last time we had a major economic downturn. We'll kind of pivot here and talk about the banking sector. And so we've got banks that hold almost $500 billion of unrealized losses on their securities portfolio. And available for sale represents more shorter term holdings. Hold to maturity represents longer term holdings. And you can see that really going back to 2022, when we had some stresses certainly in the equity and in the fixed income markets, with interest rates moving higher over this period and moving higher and then staying at an elevated pace, you can see that we do have unrealized losses that have kind of definitely picked up, and so obviously we're always concerned with the health of the financial sector, and I'm not showing you this as an alarmist, but this is because when you have a prolonged period of very low interest rates and those interest rates move higher, you're going to see increased stress on this. Banks with their capital requirements and whatnot are, not in as nimble a position to manage their portfolio as they once were. Although I did read this week that it looks like there is a move afoot to try to ease some of those regulations with regard to capital that were imposed on the financial sector after the global financial crisis. Here's another one from the camp of interesting charts department, and this is tourism, which interestingly enough makes up about 10% of GDP. This is from Torsten Stork at Apollo, and so 10% of GDP. When you think about kind of the acidic tone that we've taken towards foreign policy and the way that Trump has, kind of, engaged, longstanding allies, and you can see it in the TSA checkpoints, and you can see it in some of these cross-border numbers that cross-border traffic to America has gone down. So if you assume that trade is 10%, well, that's a meaningful contribution to GDP. Now we'll talk about the fiscal outlook, which really does open up a can of worms. And so, and this is a chart from BCA Research. Always do good work. In this case, it's looking at different scenarios. If we have the extension of the tax cuts from 2018 and whether we sunset them. In either case, the fiscal outlook really is unsustainable. And this is the big elephant in the room that's not being talked about. And this is something, that, you saw this past week where we had some conservative members of the House Budget Committee that frankly voted against the budget plan that was presented, and because they didn't feel like it was fiscally strong enough, and really didn't contribute. Essentially, it contributed to a lot of tax abatements and a lot of give outs in the sense of tax reductions, but with a very long tail kind of return on it, meaning that at best it was going to take a while to recover some of that in terms of other things that were going to raise funds for the government to offset those tax cut extensions. And, but, the long story short here is that we're going to have to come to terms with our deficits and come to terms with our debt as a country. And I'm not saying that this is going to happen overnight, and it's going to take some leadership in Congress to really get on this. Right now, we don't really have any of that from a fiscal standpoint on either side of the aisle, frankly. And I just leave this chart up here because this is one of the reasons that Moody's cited in its recent downgrade of U.S. sovereign debt to the first notch below a AAA. So essentially, we've got Fitch, Moody's, and S&P now all at one notch below AAA. Now, I had a question this week. Does this imply that maybe the U.S. is not going to be the kind of the risk-free proxy? And the answer to that is simply no. That's not going to change, because what's your alternative? You've got the next logical currency and debt that you would look at from either a currency basis or or reserve management would be the euro. And you've got a collection of countries that politically are not completely aligned, and that makes them very difficult to be aligned fiscally as well, because you've got different circumstances in different countries. So suffice it to say, the euro would be very hard pressed to replace the dollar, and as a result, I mean, that the U.S. denominated treasury assets are still going to be viewed as the go-to when you're in risk-off mode, meaning that that's the asset that you're going to invest in when you want to take risk out of your portfolio. This chart, we have really the differential between the euro and the dollar, and then the 1 year yield differential between euro-denominated debt and dollar-denominated debt. And this is very interesting because we've seen U.S. assets, we've seen that differential widen out, and this is very unusual. Again, the data series is not terribly long, at 4 years here, but it's a pretty tight data series, and so to see this is very odd. And so the headline here is just then, the dollar euro and the dollar weakness, particularly this year to date, and more importantly over the last 6 to 8 weeks here, has been driven by probably more political factors than any kind of true interest rate differential here. And so basically this chart here just underscores the fact that the political undertones have been very powerful, and in some cases have I won't use the word trumped, but in some cases have really usurped the influence that you would typically have on those interest rate differentials. Here we have the dollar spot index, as I mentioned. This is just looking at over May. We've seen a lot of volatility even over the last handful of days, frankly. And so dollar is trying to find a base here, and we've got a big spike coming off the U.S.-China trade announcement. So it gets us back to kind of where we'd recovered earlier in the month before that announcement. So this is really only half a month here, but it just shows you just how volatile the dollar can be in this environment. Okay, so still keeping on the U.S. dollar, this is something that there's been a lot of pessimism out there, and so investors are the most underweight the U.S. dollar since May of 2006. You can see where we are here, and this is kind of a net of fund managers, who trade in currencies, and so you don't see this too often, right? I mean, you get it basically when you have kind of recessions or near recessions, and so but this is as deep as we've seen it. You've got to go back here, essentially to the global financial crisis, and so dollar is not wanted. A lot of it has to do with the potential for foreign direct investment, and a lot of these things that in the vacuum of data and good analytics it makes rhetorical sense, right? If you're in a trade war and your tariffs are high and you're irritating, the rest of the world and certainly irritating your trading partners with these veiled threats and all that, then yeah, I mean, your natural inclination is going to, either to short the dollar or certainly be underweight it. And then here you've got 40% of investors. This is the B of A, again, the B of A Global Fund Manager Survey. And they're looking to increase their hedges. So that is an important dynamic. Again, it just speaks to the volatility in currencies right now and the fact that you've got an increasing number of fund managers looking to hedge their exposure to it. We've been watching gold as well. We've got this is the gold ETF, which is kind of a proxy for gold. You can see that it's moved up. This chart is suggesting that you get some midsummer seasonal easing in gold. That would make some sense, but you can see here gold fund flows have just been, I mean, almost crazy strong this year, and this goes back in over several years. And this is kind of like looking at your starting point on January 1 and where you are cumulative in over these years. And so you can see that you got to go back to 2020, which is the pandemic. A lot of people were shifting into gold, and we thought that was a big demand year, but this is far eclipsed that. So as a result, that there is a debate now that is raging to some degree, saying that gold is overvalued and that we're going to have more volatility in gold, which has been really strong and helpful. And so you basically have almost 50% of fund managers in the survey saying that gold is overvalued. Again, this is a survey, so obviously fund managers can and are certainly sometimes flat wrong about these things. But usually if you're seeing a change like this, then you've got fund managers that are actively deploying these kind of expectations in their portfolio, and perhaps we'll see a downtick of sorts in this demand for gold here over the coming months. But then again, if we have a slowness in the economy and we get some soft data that's weak transitioning into hard data that's weak, then maybe you'll see gold maintain its head here as a store of value during tumultuous economic periods. Okay, so half of expenditures on goods coming from China. This is more, trade related again. That I said this last year. Last month, you get a lot of goods coming in that are imported that are actually part of the production chain, and so they're like semi-finished products that come for refinement and finishing in the U.S. because they're taking the raw materials and the components and building assembling the interim components. I mean, that's something that other country labor pools do a lot cheaper than we do. I mean, witness, I think it was Ford, maybe it was GM this week that said, listen, we'll build, cars in America, but if you want a car that's, 30,000 now, go to 50,000, that's what you get. You get these inflated costs. And so this just shows you the complexities with implementing a very broad and blunt instrumented trade or tariff policy here, is that you get, essentially, goods coming from China, more than half of those expenditures stay in the U.S. And then Europe, not so much, but still, it just highlights the complexities that you have when you're dealing with trade and you have more complex supply chains and production chains. Another interesting chart. I've got a few of these this week. So data centers. I've been reading a lot now about the the tremendous power needs of data centers, and and obviously that it's very much at odds with kind of this whole conservation and clean energy thing, and we saw that play out for a few years, and that really took a back seat. And now you've got the Trump administration talking about wanting to reopen or recertify some of these coal plants. And we've gone from, I think, something like 45, 50% of coal production from the beginning of this century down to like 16% coming from coal. And you do have a rise in renewables, so that's wind and solar, and prices for that are coming down. And then you've got natural gas, which has really come into play here, but that's a fossil fuel. And you burn natural gas, and there are people that want to sequester that carbon, if you will. But and then a lot of debate over these SNRs, small nuclear reactors, to power these data centers. And so, I mean, basically, a power plant with, I think, a couple of hundred or 300 megawatts can power like 100,000 homes. But that only powers like a fraction of a data center. And so bottom line here on this chart, which again, I find really interesting, is you've got power estimates, electricity generation estimates coming from these areas, all of these areas. Coal is expected to, decline, which is the current track. But again, if the Trump administration has its way, they're going to recertify some of these plants. But, you need a lot of power, and we're going to have to figure this out to expand all these data centers. And I think, again, what we don't see here are these small nuclear reactors, which in the very last chart I have, it's a kind of an interesting change in opinion of what people think about nuclear energy. And it has changed quite a bit. It has changed quite a bit. Okay, S&P 500, you can see here going back pre-pandemic, some of these volatile periods. And, again, on its very basic level, I like to show charts like this because it shows you the power of just staying invested. And we talked about that earlier last month when we had some of these major downdraft days, just the power of staying invested because the bias is up over a long period of time. And so that's like job number one with this chart, just to show you that we've had these very strong downdrafts, and then we had a hiking period, and then 2022, we know there's a lot of inflation here. Fed was raising rates to fight that, but all along here, you still had stimulus at play, and now we have this tariff and issue, and so basically we've seen a downdraft and the subsequent pickup, the likes of which that we haven't seen since COVID, and that was really quick. I mean, if you blinked an eye, you really missed a lot of this downdraft because it was painful in the moment, but it went away, and it still feels kind of like that now. And so, again, obviously after COVID, markets went up for a couple of years before we had 2022, and then it went back up again. It's just I just like to prepare ourselves for volatility, as we'll see here in these ensuing charts. Valuations are not really attractive, nor do we have the positive influence, a lot of the stimulus that we had back around the pandemic period. So again, to the notion of stocks picking up, we've got an increasing number, almost 72% of the S&P 500 members are above their 50-day moving average. So that's very technically strong. That shows quite a bit of breadth. Again, another kind of iteration of that here is you see 21-day price highs, and we see here that that we have a clustering of we have a higher percentage. So we've got some recent momentum across the board in the market, and the good news is while Mag 7 has benefited, that a lot of other areas have too. But let's talk about valuation. So, as we were highlighting over a period of a couple of years, 2022, we had the market sell off. We really had valuations come back to a level that was really attractive. And so that made sense to, restructure portfolios back then, because then we got a tailwind of sorts from that. Well, valuations did come down, but like, remember 2 charts ago, we had that downdraft in the market and valuations reset, but they went back up rather quickly. And that's happening right now. So when you think about where the broad market is now, and it's about 21 and a half times, and I'd say that that's certainly not cheap, and it's almost getting back to kind of a frothy level that if you feel like earnings estimates are coming down, and they have, then that it could make these valuations higher for longer, keep them higher. And then here's the equal weighted index, which we know is also important because this has heavy influence from technology firms, which I think collectively are trading closer to 30 times earnings, which skews that somewhat. But nevertheless, valuations are moving higher. We have a chart from Goldman. Speaking of, those forward earnings multiples, and so you can see here, 10, 30-year averages, and I think, when you're in a easier credit range, and maybe you have interest rates that aren't as high as they were, 20, 30 years ago, that maybe something like this makes a lot of sense, but if you wind up, basically, if you wind up massively reducing your earnings estimates, then I think you're going to create some headwind in the market. Now, where we are now is like 21 and a half, and so we're up here. So, I mean, there is a case to be made, like if earnings estimates come down a little bit, but not much, and we maintain high multiples because of the expectation of future growth or kind of the soft landing scenario where interest rates come down and credit becomes easier and tariffs eventually go away, so on and so forth. There's a case to be made that stocks can go up, but what we don't want to see is multiples dropping precipitously, and that would create a lot of stress on the market as indicated by this chart. Equity allocation, we just got through talking about multiples, and we've had, a bit of a change here. So equity allocation, how quickly things can change too, right? So 2024, a lot of optimists out there. May 25, not so much. Again, fund managers, their equity allocation is the lowest that we've seen in a couple of years. And, the question that, again, in a survey environment through S&P Global, is that you've got a lot of perceived headwinds. So not only the political, macro environmental, this is that hard data thing that I've been talking about, a reversion to historical price to earnings ratios, which, as we just saw, is a dangerous thing. So fund managers are clearly very mindful of that. And then government fiscal policy, I mean, that's basically speaking of the federal government, speaking of Congress and their actions, as I mentioned before, that they are erring on the profligate side without as much concern as I think they need to have on the trajectory of our deficits and our overall government debt. And then less so, central bank policy. So, clearly some things that are that have fund managers kind of on the edge of their seats, and as a result, allocations are a little bit light right now. Now we'll talk about corporate credit. We did see a real change here in the last couple of months on credit spreads, and when they widen out here, that means that there's an expectation of slowing down. And so when we had tariff announcements, obviously that blew out, and then even the anticipation of the tariffs and that liberation day, so to speak, started this trend of like repricing credit in general. And this is a reasonably strong move, but then at the same time, we've seen in a pretty whipsaw fashion over the last couple of weeks a big reversal in these trends. And when we saw these big outflows that were going out of the market, and then we also were seeing kind of along strong inflows into equities, that's kind of has reversed now, and we're seeing strong inflows into credit at the same time that a lot of asset managers are light on equities. Last chart here is the one that I foreshadowed, and this is just how people feel about nuclear energy. And there's a period of time where the people were in opposition. This is still as fresh as you can be to 3 Mile Island and the Fukushima in Japan, with the meltdown, with the floods in Japan. And I thought this was interesting. So, again, this is from point to point. This doesn't represent a sea change, but you can see here from 2015 when we were at 44 and we're at 61. This is a Gallup poll, so these are individuals across the country. The consensus is that there is a place for nuclear energy, and like I said, when we were talking about sources of energy that are going to be needed for data center development, the nuclear has to play a role. It doesn't happen overnight, but we're not talking about 3 Mile Island reactors. We're talking about these SNRs, these small nuclear reactors that you can put in various parts of the country. They're easier to manage, they're less costly to build, they take less time to construct, and they can help in this energy food chain provide energy to data centers, which we know will be critical to supporting the AI revolution. That's all we have for this week. I hope you've enjoyed the chart pack. Have a great week, and we'll talk to you again soon.